as we go forward. N Jayakumar is with us, Group CEO and Managing Director at Prime Securities. Jake, it's good to have you with us here. Thank you very much for your time. So just sort of your initial first thoughts. You know, a lot of people were expecting a fall. And I also know that a lot of people had kind of stopped vocalizing and verbalizing their expectation because the market just did not fall. It just kept going higher. But we've got this now. Do you think this is it, or it perhaps has got a little bit more to go? Your sense?
Well, thanks for having me over. I think the fall got created with the excesses in the small and mid-cap space. And as the correction in that set in, I think it just happened to be a bit of a domino effect where, because FIs have been in any case sellers in the market. So we've had, you know, with international cues being particularly unfavorable, a fair amount of overhang of that coming through. And what you've seen in the last 2-3 days is a sort of a cataclysmic, to my mind, I'd like to in fact even call it a bottom. And I think at this level, we may have pretty much played out for the moment. I think the markets not just are oversold in the short term, but I think the fact that money will now come in, but come into large caps is the way I see things moving forward. There's a lot more security and safety in large cap stocks. Some of the big private sector banks, etc., fall into new lows. And therefore, there may be some rotation in terms of, you know, money moving from one bank to the other, money moving from, you know, one large cap to the other. But I think the party for the moment in small and mid caps is certainly over. And if the market were to recover, which I think it will be led by the large stocks. The index movement will be large stock driven, and nothing from a belief or a conviction perspective has shaken my confidence in any manner that this rally is here to continue. The correction has been brutal, and it has essentially left a lot of HNIs, stopped out, and a lot of positions have been busted. Rollovers have been much lower, as you will get to see. And both in terms of international flows, like let's say a large hedge fund having closed down, etc., which we keep hearing, stuff like that adds to the cataclysmic nature of the bottom formation.
All right. Hi, Jakes. Good afternoon. Good to hear your thoughts. And as we speak, Jakes, the small cap index has almost moved into the green after being down close to around 2.5%. So some hope, some kind of bottom fishing appears is taking place. But as you said, it's more safety in large cap names. You briefly mentioned about large banking names that are trading at multi-month lows. What's your view out there? I mean, what would be your pecking order, particularly HDFC Bank? It's not only important from that stock's perspective, but for the index, you have 15% of the index not performing. So your view?
We typically eschew individual stock discussions. But were there to be just one comment, which is, while we do believe that real estate exposures have, in many senses, started performing for most people. But the fact that this merger itself, which people say has been well digested, my own personal feeling is that some of the real estate exposures have tended to put a lid on the growth of this bank. And I think those may be short-term worries that are playing out. The fact it's also owned by every single investor, whether domestic, foreign, local, family office, etc., makes it even more difficult that when some exits happen, then effectively the underperformance of that, being an overowned stock, comes into sharp prominence. And therefore, every exiting shareholder ends up selling this, because it's the one stock that does give you the liquidity to sell out. So I think HDFC is peculiar in the fact that it's been overowned, and that may well be its bane for the moment, which has been its boon in the past. So that's the way I would look at it. But other than that, so I think some money is moving from there into other private sector banks, whether small or big. And that process will continue. This is, but the heavy weightage that an HDFC Bank plus a Reliance command may well be, in some senses, also a cap on the amount the index can move. And the redistribution of the index weight is a process that will keep taking place. That's why new sectors, new rallies into every, new leaders in every rally is the way we'll need to look at going forward.
Jakes, afternoon. I remember in our last conversation, you were bullish about Pharma. Are you as bullish as you were, say, 6 months ago, or do you think a lot of the good news may be in the price now? Banks you're sounding very bullish on banks as well, particularly large cap banks. What else Can you tell us in this correction, what are the opportunities?
Well, Pharma, I'm even more bullish than ever before because any number of brokerage reports did come out in the interim talking about how shortages in the US are short-lived, about how generics pricing, which had actually just bottomed out 2 quarters ago, they bottomed out, they have sort of peaked out for the moment, etc. Now, the fact is some of these are structural in nature. We've had a situation where with price impacts being the way they are, there is a move towards genericization, if you will, move towards more generics. And that is not a 1-2 quarter phenomena. I think it's here to stay. It's good for the next, to my mind, 8 to 12 quarters, at least 2 to 3 years. The interview on your channel of the FDA commissioner indicated quite clearly that the dependence on China will get switched to dependence on other markets, especially markets like India for production. So my personal belief is that the pharma rally so far has been more a trader's rally. People have seen under ownership convert to some extent to some ownership. But I personally believe that the pharma rally could be in its very, very early stages as yet. And the US generics is the space to start off in terms of focus. So that's a big thesis that will continue. Even if you see in this particular correction, they have corrected the least amongst various stocks that have corrected. And I think they will show strength and could well be, their weightage is small, so it will be difficult to say that they'll lead a rally, but I think there'll be a greater percentage of money movement into this space. And the results for some of the pharma majors over the next 2 weeks will actually, hopefully should reaffirm the belief that we have. That's one. As far as banks are concerned, we've talked about it. There's one under-owned space that I would like to talk about, which is media. Media in this country is now well consolidated in 2, 3, 4 large groups. It is a business which is as consumer-driven as any other business. It is at the whims and fancies and the price pickiness of customers. And to that extent, it's not very different from FMCG, except it's more consolidated and therefore deserves probably a better price-earning multiple. Today, most of the media spaces, despite being almost zero debt, despite being high on operating income, high EBITDA margins, are quoting at a third to a fourth of FMCG multiples. So from that perspective, I think media, A, being under-owned, B, undervalued, and have all the makings of a sector that can attract and in fact sustainably attract a lot more money than they have attracted recently. And I think all 3-4 media groups are there for the picking as we sit and watch this space today.
All right, Jakes, can't say we can complain. That's a view that I think sounds quite good to most of us over here. Good having you on the show today. Thank you very much for joining in with that perspective, and we look forward to the next round of conversations as well. All right, with that...